Welcome back. Today we're going to compare the current AI boom with the dot-com bubble era, 1999-2002. A lot of economists and analysts are raising red flags right now. So in this video, we're going to step away from the headlines and look at the data. I've summarized everything in 6 charts, going all the way back to 1999, so by the end, you'll have a much clearer picture of where we actually stand. Chart 1. Total growth since 2000, NASDAQ 100 fundamentals. This first chart has 5 bars showing the aggregate growth of NASDAQ 100 companies since 2000, over the last 26 years. Free cash flow is up 30 times. That's cash left after operating costs and capital spending, one of the most important fundamentals for long-term valuation. Earnings grew 24 times. Market cap increased 10 times, and long-term debt grew just 7 times. Here's the key takeaway. Earning power grew about 4 times faster than debt. That's not just growth. That's disciplined, sustainable expansion where cash generation has outpaced leverage by a wide margin. Chart 2. Annualized growth, CAGR. The second chart breaks those numbers into compound annual growth rates. Free cash flow compounded at about 14% per year. Earnings grew around 13% per year. Debt grew just 7.9% CAGR. That spread matters. It means cash and profits grew at nearly double the rate of debt. Over decades, that advantage compounds into real financial strength and resilience when conditions tighten. Chart 3. Debt serviceability, years of FCF to pay off debt. This next chart is one of the most important because it shows the most dramatic improvement, debt serviceability. Back in 2000, it would have taken roughly 3.5 years of free cash flow to fully pay off the NASDAQ 100's long-term debt. Fast forward to 2026, and that figure drops to about 0.8 years, less than 10 months. That's about a 77% improvement in debt coverage. What used to be a multi-year burden is now something the index could theoretically cover within a single fiscal year, an enormous shift in flexibility. Chart 4. Today's snapshot, FCF versus long-term debt. Here's the current position in plain terms. The NASDAQ 100 is generating about $775 billion in annual free cash flow, while carrying roughly $650 billion in total long-term debt. That relationship, cash generation exceeding the debt load, is a very different backdrop than the dot-com era. Chart 5. The full trajectory, 2000 to 2026. This chart tracks the path from 2000 to 2026. Free cash flow, earnings, market cap, and debt all started from relatively similar baselines. Then the lines begin to separate. Free cash flow and earnings accelerated sharply, especially after 2010, while debt growth stayed remarkably restrained. The big crossover came around 2015, when annual free cash flow began consistently exceeding total long-term debt, and that gap has continued to widen. Reality check. Pullbacks still happen. Now, none of this means markets can't fall. Even strong fundamentals don't eliminate drawdowns, especially when valuations run hot or liquidity tightens. As a rule of thumb in U.S. market history, a 5% dip is very common, often happens multiple times per year. A 10% correction tends to happen about every 1 to 2 years on average. A 20% bear market is less common, but it tends to show up every several years. And yes, people like Michael Burry and other analysts have warned about bubble-like behavior. Here's the balanced view. The market can still correct, but today's biggest NASDAQ 100 companies are entering that risk environment with far stronger cash generation and far better debt coverage than during the dot-com era. Some investors also talk about a presidential cycle, where volatility can pick up in certain parts of the term, especially when you also have rising inflation, liquidity stress, and higher bond yields. It's a tendency, not a law of nature, but it's worth knowing. One indicator I personally watch is gasoline prices. When gas prices stay elevated for months, it can pressure consumer spending and sentiment, and that has often coincided with weaker market periods. It's not a guarantee, but it's a useful stress signal to keep on the radar. Final takeaway. Let's bring it all together. The NASDAQ 100's debt position isn't just sustainable, it's exceptionally strong. Debt serviceability improved by about 77%. Free cash flow now exceeds total long-term debt, and earning power has grown far faster than leverage. These aren't small improvements. This is one of the strongest collective financial backdrops in the index's history, built on cash generation, not financial engineering.